So let's try to break down the credit score in a little more detail and see how it's really working. Now, this is something that you almost will never see with FICO, TransUnion, Equifax, Experian. They'll give you some general idea how their scores work, but they'll never really show you in detail, which is understandable. It's their secret sauce. It's how they uh, keep a competitive advantage. So they'll never really show you the details, meaning, what are the actual things inside of the score, the things that create the score. Um, so what I've done is I've taken the liberty of creating a score myself. So I can try to share with you guys kind of what goes into a score and really look at how exactly these things are affecting your overall score. And so what I've done here is I've added a few things in a model, and you probably shouldn't take this at face value. It doesn't translate exactly into a FICO score or a Vantage score, but really it's just a simulation to try to give you some idea of how a score is working and how changing different components of the score impacts your overall score. And so what we're showing here basically are some basic elements that tend to be in pretty much every score. So what we have are inquiries, which is basically an indication that you're seeking credit. So every time you apply for a credit card or auto loan, installment loan, um, basically those organizations run your credit. And when they run your credit, that counts as one inquiry, okay? Um, we'll see how these inquiries affect your score in a second. Um, Now, one of the other things that tends to be in a model is um, age of your credit, how long you've had credit, either credit of any type or credit of a specific type. In this case, we're looking at months since your oldest auto loan was opened. Okay, and really what this does is sort of gives you a proxy for age. Since you can't use age directly in a credit score, it's a compliance issue. It's against the law. Age is a protected class, so you can't use that directly in any model. Of course, age of credit or time in file really ends up being a proxy for age. And so these things are allowable in a model, and you'll almost always see them in any type of credit scoring model. The next one is utilization. Okay, what is your credit utilization, or what percent of your overall credit limit are you using? Now, this one is utilization on an installment loan. So really what this tells you is what percent of your original balance have you paid down? Okay, so you get a loan, you get some principal balance or overall amount that you need to pay back. Utilization really just says how much of that have you paid back so far. Okay. The next one is the number of mortgage trades, meaning how many mortgage trades have you had in the past, and this can be number of mortgage trades ever, or number of mortgage trades in the past 12 months, 24 months, etc. But generally, the more of these you have, the better. And we'll talk about each of one of these in detail a little more. The next one is utilization on revolving trades. Revolving trades would be any type of credit card or any type of bank card, like a Macy's card, a Sears card, Dillard's card. All these types of cards that you can get at any number of stores are considered revolving type trades, meaning you make a payment every month, but you never actually pay down to zero like on an installment loan. And then again, this is a utilization, which means what percent of your overall credit limit are you using? Okay. And then the next one, this is when it's number of trades never delinquent or derogatory. So what that means is, out of all the trades you have, if you have a car loan, a home loan, 3 credit cards, and a Macy's card, and a Dillard's card, out of all those trades, how many have never been delinquent or derogatory? In this case, delinquent means 30 days or more past due. And derogatory actually has somewhat of a strict definition. Derogatory means that it's never been repossessed, charged off, or pulled into a bankruptcy. And the last one that we're showing here is basically it's a recency variable, which basically says, okay, maybe you've had some delinquency or derogatories in the past, but maybe that's not enough. What we really want to know is how recent those delinquencies or derogatories were. How long ago did you have those? Okay, and this kind of component or attribute gives you some insight into that. So let's see how these things independently affect your score. Okay, so we'll go back to inquiries, which is, remember, it's our credit seeking type of attribute that says that you're looking for credit. Okay, and this, what we're showing here, really is an example of, I won't say a typical credit profile, but I just use it here as an example, and then we can see basically if we change these values, move them up or move them down, what happens to your overall credit score. Okay, so in the case of inquiries, here we're saying that whoever this person is, this random person that we're simulating, this person has 7 inquiries, okay, in the last 6 months. Now, what happens if we change the number of inquiries? Meaning this person, they've applied for 7 credit cards or different types of debt in the last 6 months. And let's say this month they apply for another card, okay? Then what's going to happen when they do that? So let's change that to 8. And now what do you see happen to their score? And we'll kind of go back again. See, it was 7 and their score was 644. Then when we change it to 8, their score goes down to 615. Okay, so their score dropped about 29 points just by inquiring or filling out an application for a new type of loan. The reason is that credit bureaus or lenders tend to see this as credit seeking activity, meaning probably you have some monetary issues or expenses you can't fully cover, and because of that you're seeking additional credit to try to help with that. And this is considered a negative type of behavior. And it's not just a subjective thing. This comes from the data. The data supports this. This is how these models are developed. Okay, the data shows that the more inquiries you have, then the higher your default rate is, or the higher your likelihood is to default on any type of debt. Okay, so we see if you every time you fill out a new application for a new type of debt, it dings your credit, lowers your score. And in this case, you can see it lowered it quite a bit. And that's not surprising because inquiries tend to be the strongest attribute in a credit scoring model. At least in pretty much everyone I've ever built, this is what I've seen. So let's put it back to its original value, okay, and move on to the next type of attribute. And this is the age of your credit. In this case, it's specifically the age since you first opened the auto loan. So what this is saying is that it's been 72 months or 6 years since you first opened an auto loan, okay? And remember, again, this is sort of a proxy for age. So let's say we had our first auto loan a lot longer ago than that. Let's say it was 10 years ago, for example, and we change this to 120 months. Then what do you see happen to our score? see that our score goes up from a 644 to a 664, went up 20 points. So basically what that means is the more experience you have with credit, right, the better you are perceived to be. And remember, again, this is sometimes a proxy for age, and what this really means is that the older you are, the more likely you are to pay back your debts, meaning that maybe you've had more experience with different types of credit and different types of debt. You've make more money than you did when you were a lot younger, make hopefully better decisions, financial decisions than you did when you were much younger, more responsible maybe now than you were when you were much younger. And all of those things play into you having better payment performance on your debts. And so if the age is higher, then you'll see that your score goes up. And this is also the reason why if you're new to credit, meaning you're never had any credit and you're buying your first car, you're buying your first home, a lot of times it's not that easy to do, or your rate tends to be a little high because an attribute like this is basically going to be zero. You're not going to have any months, right? So we can even look at that. If we change that to zero, what happens? And your score goes down to 605, okay? But that just means you don't have any credit, okay? And then this is perceived as a negative thing. So we'll put that back to where it was, to the original value. But I just wanted you to see how the age of your credit actually affects your overall score. And so now if we look at utilization on an installment loan, remember again, this just means what percentage of your balance have you paid down. So really here, 90% utilization means your current balance on your loan is 90% of the original balance, which really means you haven't really paid down any of it. You still owe 90% of it, okay? So what happens then once you start to pay down that balance, okay? So let's say if we change that to 50%, meaning you've paid down 50% of the balance on this type of loan, then what happens? Boom, we see your score goes up 30 points, okay? And so all that shows is whatever your balance was in the past, you've made some consistent payments over time to bring that balance down, and that's a positive thing. It shows positive payment history, which is good for your score, okay? I think that one's pretty easy. You don't need much more explanation on that. The next one is mortgage trades. Number of mortgage trades. This tends to be in all models as well, or at least in some form or another. And here we're showing an individual that has 0 mortgage trades. Okay, they don't have any mortgages. They've never owned a home. Okay. So what happens then if we change that to 1, for example, meaning this month they buy a home, okay, then what's going to happen to their score? Well, we see just by adding a mortgage trade, we've increased the score by 20 points. That's a positive thing, and the reason why is because the idea is that if you were able to get a loan from some bank or a lender, then it indicates that your credit and your payment history was good enough for you to qualify to get that loan, which is a positive thing, as opposed to someone who has never had a mortgage. On the other side, that's an indication that they were not able to qualify to get a loan, which is an indication that that they either have bad payment history or that they would have poor payment history. So let's move to the next attribute. This one is similar to the installment. It's a utilization type characteristic. But instead of utilization on an installment loan, it's utilization on a revolving loan. And remember, your revolving loans are your credit cards, bank cards, premium cards that you apply for. And here, basically, it's saying that this person is utilizing 90% of their credit limit. So basically, the balance, what they owe on all these cards, is 90% of their limit. Basically, they're almost maxed out. 100% would mean they're using all of their credit limit. They'd be completely maxed out. Okay, so this person is pretty close to being maxed out, which basically contributes to them having a low score. Okay, now if we do like we did on installment and we change that to say 50%, for example, then we see their score goes up to 664. It's better, right? And usually they tend to say that, you know, you should keep your utilization at about 30%. So you see, if we do that and then do 30% for the other one, all of a sudden, changing only those things, leaving everything else the same, your score has gone from 644 to a 703, just by keeping your utilization, you know, on track. And these are sort of the benchmarks or the rule of thumb that they give in terms of where your utilization should be. So if you have balances on your credit cards that are close to the credit limits, you know, try to pay those down the best you can, because when you do that, it directly affects your utilization, which you can see has a pretty big impact on your score. And the other thing about that is, in a prior video where I talked about amortization on a car loan and how paying your loan a little early every month saves you in interest costs. And we talked about how paying a little extra every month towards your principal balance saves you in interest costs as well. The other thing that does that we didn't talk about in that video is it actually improves your utilization on your car loan, okay? Meaning that if you're paying it down a little faster than you normally would, or faster than your contract allows, then that is improving your utilization, okay? And then by doing that, you're actually raising your credit score. So there's another benefit of doing that. All right, so if we look at the next attribute, this one is basically your payment history. How well have you paid debt when you've had debt? Okay, this one looks at basically all the trades that have never been delinquent. Okay, so in this case, this says that if a person has, for example, 10 trades, car loan, home loan, several credit cards, for example, out of those 10, 5 of them have never been delinquent or derogatory, meaning 5 have never been 30 days or more past due, and 5 of them have never been repo or charge off or pulled into a bankruptcy. Okay, now, so what we'd expect is if we make this number higher, then we should see our score go up, meaning a higher percentage of our loans that have never been delinquent or derogatory should improve our score. And so if we do that and say raise this number to 80%, for example, we see exactly that. If we go from a 644 to a 674, and of course we say if none of our trades have ever been delinquent, then we're looking at 693. Of course, the score is not as high as you might expect it to be, because of course the utilization is still pretty high, 90% on these. But of course, if you brought those down and your trades were never delinquent, then your score would be much higher. Okay. Now, if we look at the last one that I've included here, it's number of months since delinquent or derogatory. You know, so all delinquencies and derogatories aren't created equally. If you had a delinquency or a derogatory or some credit issues 10 years ago, that's pretty different than if you've just had one recently. Okay. Generally, the further back your delinquency or derogatory is, the better it is. So in this case, this person had a delinquent or derogatory rating on their credit within the last 12 months. Okay. Now you can see if we change this, for example, to 60 months, right? Meaning now instead of a year ago having a delinquency, they haven't had one in the last 5 years. Then you'll see that their score goes up. In this case, 20 points. And so the further away you get from that bad credit incident, the more your score will improve. And pretty much all models take this kind of thing into account. Basically, they don't hold your delinquency or derogatory against you forever. Meaning the further away you move from that event, then the more your score can improve. So in this case, I just included these because they sort of represent some of the major items that are a part of a credit score. There are some other ones or different variations of the ones here that I've shown. But pretty much these are in some shape or form in all of the credit scores that you come across, whether it's by FICO, your FICO score, or your Vantage score, or even some customized score that other companies might build. Again, they can add some other types of attributes to enhance the score or make it more accurate, or to take into account things that they think are also important. This is just a simulation, so again, don't take this at face value. Don't go out and say, hey, I decreased my utilization from 90% to 50%, and my score didn't go up 40 points like you showed in your video. Results may vary because all scores are different. FICO score is different from the Vantage score, and the actual items that they use or the components they use in their score also vary a little bit too. And again, they never tell you what they are because that's their own secret sauce. In this case, I've built a model and I'm kind of being transparent and showing you what's in my secret sauce, so that you can get an idea kind of what's under the hood, what it is that makes these credit scores work. And so you can see, when you change these things, what is the impact that it has to your score. And this is something you generally never see with other scores like FICO and Vantage score, because it's a competitive market. They just can't show you this kind of thing. But I just wanted you to see in general how this works, and so that's sort of the whole idea of this simulation, so that you could see that. But this is important, and I hope that it's been helpful. I hope that you've been able to gain some insight into how these scores work, and even more importantly, what you can do to change some of these things so that you can improve your score, and upon improving your score, being able to leverage your score to obtain more favorable debt, and then maybe even being able to leverage that debt to put you in a better financial position. Thank you.